Good morning, Jags. This is Fahad. Today is Thursday, August 6th. I want to start off with Russell 2000 index. This chart in front of you is starting to break out, and this is where all the trouble spots are. So this is where all the mid cap and the small cap value names are. If you want growth, you're going to have to take a look at NASDAQ, which is all the tech stocks, most of them at least, and then some healthcare components there as well. If you want value, particularly in the small cap and the mid cap space, you take a look at the Russell 2000 index, and the S&P 500 index is basically a very nice blend of both of them. Now, I bring this up. I want to start off from here because let's go back to this note that I wrote in the third quarter outlook that you all got in the first week of July, in which I mentioned that the second quarter liquidity injections by the Federal Reserve had driven extreme amount of money flows into the growth sector, which is mostly NASDAQ. And then if there is going to be a theme developed in the third quarter that has to do with reopening or economic data getting better for any reason, or even the vaccine that may come out sometime in the third quarter, value stocks which have disconnected materially from the rest of the crowd will potentially get a lift higher. Now, in this particular note, there was a specific comment that I highlighted, which is during Q3, expect value stocks in these five sectors: industrials, transportation, financials, mining, and materials to sharply spike higher on any strong sequentially improving forward-looking macro data, such as manufacturing and services new orders in PMI reports, ISM data, consumer confidence, and sentiment. This is a very important point. So anytime when you will get any kind of sequential improvement on any kind of important forward-looking macroeconomic data, expect value to start outperforming and NASDAQ or tech stocks to start to subside. Now take a look at what has been happening the entire week. If you look at this week, the ISM manufacturing data came out, which was much better than expected and well above 50 reading, which means expansion. The ISM services data came out, which was also much better than expected. The PMI data came out, which was better than expected. And moments ago, the weekly jobless claims came out, which is one of the best reading that we have seen in at least 3 months. The weekly jobless claim that just came out is 1.1 million versus expectations of 1.4 million. Also, the continuing claims have now dropped from 17 million down to 16 million. So this is a proxy for slightly better and improving job conditions in the United States, although I still expect the number to be remain quite elevated in the high single digits or low double digits when the actual July job report comes out tomorrow. I wanted to bring this up. This is all positive for Russell 2000 index. So you can see this was starting to break out in the last 2 days. Yesterday was a big candle, and I expect this momentum to continue today as well. So if you're looking at the S&P 500 index or NASDAQ to try to gauge some sentiment, you're doing it wrong. You have to take a look at Russell 2000 index, given the macroeconomic condition that is economic conditions that is showing sequential improvement month over month. So keep an eye on Russell 2000. Now, with that said, I do want to touch on two stocks real quick. The first one is Maximus, symbol MMS. Now, for those who do not know or missed our discussion a couple of weeks ago in webinar, I presented a bull case for this stock in a webinar. I'm pulling this up on my other screen right now. This company posted earnings this morning at 6 o'clock this morning, and it is quite impressive. So first of all, here is the discussion from webinar in Maximus, and twice we discussed this. We talked about this company provides the business process services to government health and human services. It is going to be a big beneficiary of government-led contact tracing programs that have been launched gradually in one state after another. And it also has already received over $150 million in awards, according to what we knew last time, and those awards are only going up. Lastly, we talked about that this company has seen small but unusual upside leap call accumulation as well, and we recommended that you could go long by buying October 75 call options if you are interested in taking a position in this trade. Well, this morning the company posted earnings that is an absolute blowout quarter. Quite impressive. They reported third quarter revenues of $901 million versus $801 million estimate. That's a huge beat, $100 million beat of equates to about 12 to 13% upside. They also posted EPS of $1.04 versus 78 cents estimate. They raised fiscal year 2020 guidance, and the 2020 year ends in the September. They guided to a midpoint of $3.25 versus $3.05 estimate. They raised the full year revenue guidance to $4 billion versus an estimate of $3.2 billion. So think about how big this. Sorry, I'm reading this wrong. They raised the full year guidance to $3.4 billion versus $3.2 billion street estimate. And lastly, the free cash flow guidance was also materially raised to about 275 million versus 248 million. This stock is slightly moving higher. It hasn't moved much. So it closed at 76.57. The bid in the pre-market is 77. The ask is 80. I expect this thing to continue to push higher. It's clearing through major VOP resistance level right here. I think this thing is going to go to 80 to $85 per share in short term. So keep an eye on this stock. Technically, it looks fantastic and it clears a lot of VOP congestion level, and it goes from the lower end of the channel to the higher end of the channel. The stock is Maximus, symbol MMS. Another thing that I want to discuss real quick is a name that we really like, which is Maxr Corporation, MAXR. A lot of our clients took a position in this stock yesterday after earnings came out. Or before earnings came out. We provided a preview. We recommended buying call option. This stock is powering higher sharply in pre-market. So this thing is already up 10% now in pre-market. It was originally flat after the earnings came out. Now it's up more than 10%. And so you can see that this thing is now trading at $23.10 per share. So our call options we bought yesterday are likely going to be up somewhere between 50 to 100%, depending on where the stock opens and goes. But more importantly, if you look at the weekly scale, this is the level that I highlighted. I mentioned that this is a very big breakout that we're observing in our hands, which is the long-term weekly basing formation. And then we ended up getting a very nice cup and handle formation. It's starting to clear that $21 resistance. And this thing really opens this up all the way to about $30 per share. And who knows, could be even much higher over the course of a long term. Wanted to bring this up because this is an absolutely fantastic quarter. Demonstrated resilience that I expected in my preview, looking at a lot of the earnings tidbits that came out this morning. Most importantly, the company continues to grow its backlogs. That was my main theme that I discussed yesterday, that not only they have received a ton of new orders in the past couple of months that's going to shine in the current earnings report, but on top of it, they have also, we are still anticipating a large $300 million order that's going to come from NRO, which is expected anytime in the next month or two. When you add that piece together to the total number of, they had $600 million in new awards in the first quarter, and then they got another 400 million orders in the second quarter, and now there's another $300 million order coming. And the turnaround time for these orders is quite fast. So what's happening is that the second half sales outlook has dramatically improved because they're going to start filling these orders. So this company will essentially go from reporting a revenue run rate in the first half to then a revenue run rate in the second half each quarter. That's going to be materially like a hockey stick improvement. And that's what we're seeing in this earnings report, just giving you a high level. So I think given those conditions, I think when the street catches up to this, they're going to have to come in and they're going to have to raise guidance, and they will continue to do so. Continue to raise estimates going forward for the second half and then potentially for 2021 as well. So I think this breakout will continue for a while. And while I'm at this, I might as well discuss also PGNY, which is also a technical setup for a breakout. We covered this yesterday as well. We provided a bullish trade idea, and this thing is setting up. This is PGNY. This one is setting up through a breakout from $28 resistance. Let's see if this is able to do that today. More discussion on this one in the chat room later, but I do want to discuss that it's quite resilient to find out that a company of this kind, despite the COVID disruption and everything, has been able to rebound its utilization rate all the way back to 90% of its pre-COVID level. And more importantly, despite a tremendous amount of disruption that they saw in the month of March, April, and May, the sequential improvement that the company talks about in starting from middle to May up until the end of June, which was reflected in the second quarter earnings that came out, it shows that the full quarter revenue growth is still ended up being 16% higher year over year. So, and they have already reached 90% of the previous utilization rate. Company is a highly profitable company. They print money, very high margins in this particular business. They did shut down expectations a little bit for fiscal year 2021 just because they're a little bit worried. They're setting significant amount of conservatism in this tone. So the fiscal year 2021 revenue guidance that they're providing was a bit below my expectation, but they did say that this is conservative. But I think that it's important to notice how quickly we have seen the rebound in this company. It's one of our favorite names. It was presented with a big bullish case in the first quarter Jaguar outlook as well. So I do think, let's see if it happens today or maybe in a couple of days, but I do think this thing is going to break out through $28 per share, and it's going to make its way back to the highs that we saw before COVID, which was well into mid 30s over time. So keep an eye on PGNY. All right, that's it from me. Chronicle.
Good morning. Taking a closer look at VIPS shop this morning, symbol VIPS. We're currently long November calls, and since we already have a position, I thought I'd share my thoughts here rather than do a whole Jaguar Media presentation. For those who are not familiar with this company, this is an online discount retailer in China for household goods and clothing. They're the biggest player in this niche. So if you're in America, just think of them as the Chinese online version of, say, TJ Maxx or Ross. That's what VIPS shop is in terms of e-commerce equivalents. If you were to go to their website, you'll see that they're not exactly doing anything revolutionary. It's just a basic e-commerce website at its core. Nothing wrong with keeping it simple. But moving on, I wanted to talk about this company because when I look at all the recent sell-side notes on the company over the last couple months from JP Morgan, Credit Suisse, and UBS, the research on this company has been pretty inadequate from all three. Like, the analysts are only focusing on the revenue and demand projections, and they fail to talk about the other major bull case for this stock, which is the company's ongoing improvements to their profitability and margins. So I just wanted to add some bottom-up color to the margin side of things. So late last year, what happened was the company closed down its delivery segment because they realized that they had no expertise in fulfillment, and they were taking on too much growing expenses because of that. And so eventually they shut down their own delivery division, and instead they contracted a third party called SF Holding, which runs SF Express, to do the delivery starting December last year. And if we look at this chart that I shared, we can see ever since that decision, the fulfillment expenses as percentage of revenue, which is the line chart here, it's gone to all-time lows. And looking ahead, I don't think this expense ratio is done going down for two reasons. First off, the COVID-19 crisis in China during the first half of this year has caused a lot of discount and wholesale businesses to close permanently. Like, there was this channel check during Q2 by Chinese Business Information Database showing that wholesale represented 38% of the 430,000 businesses that went under. That's no joke. And they're projecting about another 300,000 closures for the rest of the year because export demand remains weak. So the first thing here is less competition for VIPS shop. But the other bull case that's more obscure is that the third-party deliverer SF Express, they've lost a lot of their customers at a time when VIPS shop is beginning to build out its network for its non-standard merchandise. Basically, all those items that need a little more attention when being handled. So if VIPS shop decides to contract SF Express for that, or any other mid-sized logistics provider for that matter, they're going to have a ton of negotiating power. And the other thing is that during the most recent conference call, the CEO of VIPS Shop said because of the pandemic, VIPS Shop suppliers were offering a lower discount than usual because of a lot of excess inventory. And when I look at how Chinese retail sales numbers are still negative through Q2, while manufacturing has already been up and running for months, I think this supplier excess inventory is going to persist at least through Q3, which again will mean lower expenses and better margins for VIPS Shop. And lastly, on the demand side, if we go and click on any of the popular products on the VIPS Shop website, if we scroll through the past customer reviews, one thing we'll notice is that after the company made the change from in-house delivery to third-party, so starting last December, a lot of the reviews have talked about how fulfillment has been quick and professional. Whereas if we look at the comments before last December, I'd say a lot of the comments were about long delivery times and also complaints about rude caller service, which shouldn't be surprising because third-party delivery services tend to have better knowledge of what they're doing. So I think this also stealthily helps future demand growth, not just margins. So this improved satisfaction and customer feedback is another thing that the sell-side analysts haven't really touched on. And when they talked about their projections, in their research notes, they were just loosely citing macro trends and linearly extrapolating the growth and then just leaving it at that. There's a couple other minor points on the margin side, but I think I'll share those in a future presentation on a similar Chinese stock to VIPS Shop. So I'll talk about that another time.
Good stuff. From this discussion that you just mentioned, it seems like in this particular case, we are really talking about one aspect of the company, right? Which is the ever declining fulfillment cost side of the structure as a percentage of revenues, which is clearly beneficial for the profitability, for the margins of the company. And so do you know, on top of your head, if this has shown, at least in the last quarter or so, a material impact on the profitability of the bottom line, or this is a trend that is more of the high-level trend that is more interesting here rather than a single quarter print?
So in the last quarter, when management answered a question regarding margins, they said that it materially contributed to their earnings growth.
That's what I like to hear. Materially contributed. You know, if that trend continues, we're going to see more of that. We're going to see more of that in the second quarter earnings that's coming out pretty soon, and then beyond that as well. Good stuff. Something new I learned today about this company, even though I really enjoyed this one holding call options. Jay.
Hey, Fahad. So I want to talk about SITM, SITM. For those that do not know, this is a top pick from the Q3 Outlook. Company reported earnings after the close yesterday, beat on both the top and bottom line. Revenue increased 1.2% sequentially, 35.5% year over year. Looking at its different segments, mobile, Internet of Things, and consumer, that was down 14% sequentially, but it did essentially beat their original guidance, which was down 20 to 30%. Now they are expecting this to continue to increase in Q3 and then additional growth in Q4 due to seasonal strength. Industrial, automotive, aerospace, that was up 10% quarter over quarter, and then communications and enterprise, that was up 20% sequentially. Design activity was solid as well, with 300 new wins in the quarter, including 50 design wins for its Elite and Endura platform. Post earnings, you've got Barclays raising their target to 75, Raymond James to 70, Needham to 67, Stifel to 64. And looking at the what they gathered from the conference call, a few things. 2 new products were introduced. One was a high performance oscillator targeting 100G to 800G optical modules. And I think more importantly, they announced its first family of clock IC products called Cascade, which is going to target 5G telecom data center applications. And this essentially is going to open up a new market for them. William Blair is out with a note saying that clock ICs represent a $1 billion incremental market opportunity. And they suspect the Cascade family of products addresses approximately 75 million in TAM with initial revenue, likely next year. They also expect additional clock IC product announcements next year as well. And then lastly, in terms of Apple, Apple comprised 26% of SiTime sales in Q2. And one of the things we talked about in the Q3 outlook, or one of the catalysts we talked about, was how they have the potential to win future iPhone sockets. And sure enough, that is what looks like that's what happened. William Blair also saying, if I can read this, Q3 guidance excludes revenue from a likely phone win at we suspect its largest customer, Apple, due to conservatism and the timing of the launch. While management did not provide details around the win, we suspect it won 1 or 2 timing sockets in one phone SKU. So, I mean, one of the catalysts we highlighted played out, and just overall a solid quarter from them.
Yeah, I was reading the transcript and a lot of management comments last night myself, and I thought everything was impressive across the board. Positive tone by the company, clean, easy beat on top and bottom line, sequential improvement from Q1 to Q2, which is very difficult to find in this market. Even with the V-shaped recovery that has seen in a lot of stocks, sequential improvement has been difficult to see, and this one does easily that. And the more important thing is this company has the partnership, or it's selling products in the growth markets where a lot of the big guys, the hyperscalers and the big OEMs are moving in. So it's going to continue to benefit from that capex environment continuing to remain quite strong from Apple and such. So we recommended this right here, as you can see in the Jaguar Q3 outlook at $45 per share. This stock is pushing towards 60 now in pre-market. So it's already up over 30%, 35% since the entry. And I still think this is a winner in the long run. I think we're going to see more upside. So great stuff on this one, and a great call for including this in the Q3 outlook. Fantastic. Avo.
Morning, everyone. On my list, or on my chalkboard, is Nutanix, NTNX, which reports near the end of August, so about 3 weeks from now. Last quarter, the company had a good quarter actually, but stock the reaction was kind of muted. Mainly, what's happening is that they continue to be shifting their business model to subscription, which is now at about 80% or so. They posted some good numbers. Accelerating subscription transition continues. There's strong demand for their virtual desktop infrastructure product. They had closed 59 deals, I think over $1 million in total contract value of bookings. And more recently, I have a note by Needham just about 3 weeks ago or so, saying that their product demand is still high, or appears to be high, and potentially long-tailed opportunity as end user computing customers are looking for to kind of get prepared in case there's a prolonged absence of returning to work in offices. So they would set up this kind of workspace at home. So we still got about 3 weeks to go, and hopefully there'll be some channel checks or something that come out between now and then. But that's what I see so far. I did see some call buying, but that was a couple of weeks ago when there was some rumors that Google might buy it. It's not something that I would go into betting on being acquired, but apart from that, I haven't seen much at this time.
First of all, on a technical side, this actually does have indeed a very nice technical setup for a breakout. So I give you that. This is a major VOP congestion level up to 2450, and if it starts to clear that, and the recent push that happened was on very, very heavy volume, as you can see on July 17. So if it pushed through the 2450, I think this opens the floodgates for a lot of this air pocket above the stock. If you can capture even half of that on its way up, then I think this makes a very, very interesting trade to the upside. Secondly, you see this volume in the September 25 and the 30, over 5,000 open interest in these calls, and then also if you look out to October, and you will see the 2,000 open interest in the 22.5 and the 25. As you were talking, I was just pulling up data. A lot of this was accumulated in the month of June. And so this was some time ago, a month or 2 months ago. If you look at the October call options, these October 22.5 call options, they were more recent. You can see there was a big spike on July 28th when over 1,400 of these were bought to open for up to $3 per contract. So nearly $500,000 bullish bet in the October 22.5 call. So they remain in a position in that trade as well. So there has been some very interesting accumulation. And lastly, I think you're right on work from home theme. This thing benefits from that as well. We have seen a lot of the other companies in the similar environment continue to benefit with sequential improvement. So I think this one is no different than all of the others. Definitely will be keeping an eye on this. Good stuff. Thanks for bringing up to the attention. By the way, Avo, nice update on Rent-A-Center yesterday when you posted that article on homepage. For those who missed, right on homepage yesterday, there was a bullish article that was published as an earnings preview yesterday, 1 hour before market closed, on Rent-A-Center, talked about what we're seeing and such. And this morning, the stock is guided higher sharply, even though the market is going to open rather flat. But this is up about $1, so about 3% in pre-market. I don't know if anybody took a position or not, but we're going to see new 52-week high in this stock after a good quarter. So good for that. Thanks for that. Very interesting article. Anyways, gentlemen, thank you very much for joining. Good stuff. We'll see you in the chat room shortly.